Hey, everybody. Welcome to the Trader's Edge. My name is Bob Ichino. Normally, next to me is a less attractive guy named Jim Iorio. He has been sent away. He's been canceled. You won't be seeing him anymore. I'm just messing around. He is on a well-deserved vacation. And we like our time apart, Jim and I. We actually do, because we argue and we fight, and kind of like brothers. Me being, of course, the older, better look. I think he might be older than me. Doesn't matter. But we got a special guest co-host, who I think you guys are going to like a lot. Wicked smart, quick, funny. Let's just end this and get to the guest. I don't know if Jim is going to appreciate that, but I know he'll do much worse if I ever take any time off. So I'm not terribly worried about it. Shana Orchek Sissel. I knew that.
You said the harder name right, and
that one's. I'm an immigrant kid. That one's easier for me.
Yeah. Well, you said that one right, and
the more consonants, the better, is the way I'm looking at it. Banyan Capital, you just won an award. A Fintech award. Can we talk about that for a second?
Yeah, and it was kind of caught me off guard because we got this random email. It was like, you've been nominated for, the Wealth and Finance International Fintech Awards. And, I get these emails all the time. It's like, you have been nominated for an award. If you pay us $2,000, you can be in the magazine and get the award. And I refuse to pay for awards. I won't do it. I just think it's leaves a bad taste in my mouth. So I ignored it for a while, and they kept sending it to me. And I finally responded and was like, do I have to pay for this? Because if so, you can just stop emailing me. They're like, no, not at all. If you want to be in the magazine, yes, but the award's yours either way. And I was like, awesome. And then I looked into it, and it turns out iCapital, which is a huge access platform in the alt space, won this award 5 years ago. And I thought to myself, I hope this is an omen of things to come in a good way, because, winning a Fintech award and being nominated for a Fintech award of this nature, and the people who have won it before us, were really successful. So let's hope that sign of things to come.
I think it will be. And I hope you don't look down on me, because I have a case full of awards that I paid for. I think I paid for more awards than I have money in my trading account. So, you're telling me I didn't earn all those? I guess I earned the money to pay for them.
I'm not saying that at all. I'm just saying that, as a startup, we are willing to put ourselves out there only so much, but we have no budget for that stuff. So it was kind of nice to have something come across that we didn't have to, pay extra or advertise in a magazine to be qualified for.
Well, from my experience with you, you probably deserved it. Most likely you deserved it more so than my paid for awards. So let me ask you, can we talk a little bit about Banyan Capital first, and exactly what you guys do? Because it is such a cool company. I want people to know what's going on over there.
Well, thank you for letting me do a little self-promotion. I appreciate that. So Banyan is a fintech company that's looking to help financial advisors, specifically independent financial advisors, allocate in a scalable way to alternative investments. So we do everything from things that you would expect to get from a TAMP, which is creating models of ETFs and mutual funds that are specifically in that alternative world, managed futures, long short equity, market neutral. I can go on and on. So we have partners in that space that have models that you can allocate to. I run my own models in that space for clients who aren't accredited. And then we are building out an access platform of, private fund offerings, accredited investor hurdle, qualified purchaser hurdles, that are specifically firms that want to partner with financial advisors, not just a money grab, big institution just looking for more ways to raise assets, but actually smaller, more boutique companies that are doing something a little differentiated, that really want to be partners with financial advisors. So as we build that out, we're hoping to have a nice array of potential private fund offerings that advisors can use to help clients be introduced to that alternative space, varying levels of liquidity, filling all the major holes, as well as what we like to call the ego and impact plays. And then we're doing an integration with a technology partner that will allow us to plug in to all the reporting and back office softwares that advisors use, like Orion and Adapar and Tamarack and all the big ones, which will allow for streamlined reporting of private offerings with traditional investments. And we're super excited about it because we think it's a game changer. And I started my career as a financial advisor, and I've spent the last 6 years working specifically with that world. And I feel like I have a good understanding of what they want and what doesn't exist today that they really need solved for. And I'm hoping that our solution is we execute our plan well so that we can provide the solution that I think advisors really want to the market.
So I definitely don't want to get to markets, but something you said there struck me, that small to medium financial advisor, which I suspect a lot of people watching this have a financial advisor of some sort. Mm-hmm. And here to kind of trade a little bit for themselves. Maybe they generate some alpha and kind of get a little bit of, what I call the Wisconsin Dells becomes a trip to Paris money, right? Yes. And then you look at the small to medium sized financial advisors, and that was a neglected space for a long, long time, was it not?
Mm-hmm. No, absolutely. And this is something I think that, the person who's out there that might be trading their own account, one of the areas that they kind of need a financial advisor to guide them through is the alternative investment space, whether it's collectibles, wine. We're meeting with a potential partner who has a whiskey fund, which is pretty cool. We've talked to some people that are doing things in like the sports realm, that are sports rights and fractional ownership interest in professional sports teams. Private equity, private credit, the more traditional alternative world, real assets like timber, real estate, that kind of thing. You really do need to work with an advisor to gain access to that. And you want somebody who has expertise in that space. And there really isn't a platform out there that kind of combines the idea of the OCIO of somebody who has specific expertise with the access and the scalability function of it, which is kind of what I think any investor would want, to be able to speak to somebody with expertise. And any advisor would want to be able to know that these are fully vetted, partners who are committed to working with advisors and their clients and be accessible. And, in something as complex as the alt world, accessibility is a big component of being comfortable with the space.
That is so cool. And it just gives, again, these smaller advisors the sort of access to be able to say, yes, I can do this for you as well.
Exactly.
I knew a lot of traders coming up at the CME, the Board of Trade, myself included, that you were making great money and you're like, well, now what? You go to a financial advisor and it's like, okay, well, I know how to make money. And the key is, and we actually talked about this on our podcast, the key is not necessarily making it. Like making it, a lot of people know how to make money. It's keeping it and growing it over time.
Yeah, I totally understand, because I run into this myself. Like, I don't need a financial advisor to run my money. Like, financial advisors hire me to do that. But I do need somebody to give me a plan. Mm-hmm. And so, that space that we are catering to is the space where advisors do just planning, fee-based planning, or they might, run or, take custody and have discretion over the assets. But they're capable of doing that because they're not captive to some sort of broker dealer, that is making commissions and things of that nature. I do think that, the vast majority of people, even if they know how to pick stocks, don't necessarily know how to plan for retirement or, save money and make sure that they can cover for a rainy day or whatever their goals are. And it's this market of advisors that we kind of target, that are the people that offer services like that.
So one of the reasons I like talking to you is because you don't find a lot of people that started out as financial advisors, but yet have this sort of macro skill set that you have. And I'd like to talk to you another time about how you developed it in the first place, being a financial advisor. But we had some data today, right? It was the services PMI data, and it came out. I mean, I guess you'd call it hotter than expected, hotter than last month. Do you have any view at all in terms of whether, because obviously we've seen manufacturing composite PMIs, both globally and here, kind of get worse while services PMI stays steady. Do you think one's going to drag the other in one direction or the other?
Maybe a little bit, but I think what you're seeing is something that's been predicted for a while, right? During COVID, people had all this extra money and they were spending it on things. And there was this prediction that eventually they would move to services and experiences, but it didn't happen right away. It's gradually gotten there. The services, the non-manufacturing and services indices have consistently been stronger than manufacturing. So what you're seeing is that continued drive away from purchasing goods into experiences and services. It started with like travel. You know, you saw hot airline fares, hotels, things of that nature.
Travel story.
And now you're starting to see it in other ways, but it's all coming down to this drive for services versus for goods.
So do you see a slowing anywhere in the economy, or do you think it's kind of still at that point where it's hot enough?
Well, it's interesting. The Beige Book came out today, like 30 minutes ago, saying that like they're seeing slowing growth overall. And the Fed has kind of been hedging some of their language, suggesting, well, we're seeing some slowdown in the economy. And we have, like, the employment markets is one of those places. I think we have some charts here. One of the charts that I have is the employment market rate of change that I would love if we could pull up. It's just showing that, we continue to see job growth, but the rate of change is, nope, that's not it. That's definitely not it.
That is not it.
That is not it at all. There we go. Nope, you just had it. The next one.
I'll get better as the show goes on at this.
Nope.
One more.
Next one. There we go.
There we go.
Annualized change. So, a year ago, you saw 3.1%. Now we're at 1.5% of the annualized growth of jobs, of employment numbers, of new job openings. And you're seeing that slowly slow down. That is indicative of a slowing labor market, which we kind of wanted to see because it was too hot and too tight. But it's still growing. So there's something to be said there. And where you're seeing a lot of the job losses are in spaces related to like manufacturing. Biggest job layoffs is happening in warehousing, which makes sense. So, these are just examples of things that you're starting to see some weakness, but, we can argue, will there be a recession? Will there not? Is there a soft landing coming? Is it a hard landing? But what you can't argue is that rising interest rates and above target inflation is not indicative of an environment where you see improving growth. Right. It has to slow. The thing is, there's so much excess in the system that it's taking forever to remove it. And even at times when the Fed was being restrictive, other fiscal policies were happening that were not restrictive. And now those are starting to roll off. Student loan repayments, the employee retention bill from the IRS is rolling off. Student loan payments are coming back on. And now we have the Saudis reducing production because they want to see oil prices up at 90. These things are not good for economic growth. And, I know we look at CPI ex food and energy, but the consumer feels the food and energy more than the other stuff. So rising oil prices is going to feel inflationary to the average person. And so these are all things that are not necessarily good for economic growth. Now, I don't know when we'll see a recession. I have admittedly sucked at calling a recession.
Same here.
I've just been wrong. Not that I don't think a recession is coming. I just underestimated how much excess was in the system and how much willingness people who had job security would be to spend, even if it meant using credit. But you are seeing rising default rates in like the subprime area. You're seeing a lot of different indications that there are headwinds to growth. And it's hard to see a scenario where we don't have some sort of economic weakness. Whether it's a shallow recession or not is up for debate. But I think the longer it takes for it to happen, the more likely scenario that it's worse than people expect.
I want to put up another chart if I could. Every single month in 2023 has seen downward revisions on non-farm payrolls. And that was actually a little shocking to me. I mean, being more of an active investor, I'm looking at 1 month versus last month's revisions. And this is from Invictus Research, Mike Singleton, who's a really good friend of our podcast, The Future's Edge, and we'll probably have him on this show at some point, created this chart. And I started looking at this and it's difficult. You get a lot of people that doubt data, right? And so there's two things I want to ask you about, and I don't know if you have an opinion on this or not, but when you get these headline figures, two things. Number one, the initial move we see in any market is generally the wrong one when that headline number comes out. And that's obviously a very short-term phenomenon. But when you see things like this, does this make a trend? I mean, when you see these kinds of revisions, some are seasonal, some are just the response to the non-farm payroll survey and everything else has been dropping. Do you see anything in that?
A little bit, but like you can look at other drivers to kind of act as confirmation. Keep in mind, payroll is backward looking, but
Right.
forward looking things are like layoffs, temp workers, those things are showing weakness. The revisions have brought the unemployment rate up to 3.8%. It's still well below like, standard unemployment. I think 5% would be concerning, and we're nowhere near that. But there's clearly weakness and nothing that would indicate that we're going to see a change in this trend. But again, this is not a leading indicator. This is a lagging indicator. So paying attention to some of the leading indicators is interesting. And we talked about it already, that ISM non-manufacturing survey. One of the areas of strength has been in the services is employment, and it's demand, it's supply, not demand. That's the issue. But we're seeing layoffs in some of the big tech and in like more of the good oriented things like warehousing and the like. And another more leading indicator is employment rates and hiring rates. Most of the hiring in the US happens with businesses with less than 500 employees. So small businesses have largely driven the labor markets, and they have been largely positive. If you look year to date, businesses with more than 500 employees are net negative in terms of hiring, whereas anything under that is massively positive. But more recently, we've seen that start to drop off. And again, on a leading indicator basis, these are signs of concern.
So there's a lot of people that think that we're on the precipice of something big. I mean, it seems like every bear market, every bull market over the last, say, 5 to 7 years has been the new most hated bull market since the last one. And it feels that way in this one as well, although I'm never willing to call something a bull market until there's a new all-time high, simply because if it all of a sudden reverses, it never reached bull market territory in my view. But do you see things, maybe I should preface it with this. I think not this recession, but the next one is going to be horrendous. Whether it's 5 years from now, 7 years from now, I look at the budget numbers from the US government. I look at the distrust, the mistrust, tax receipts going down while taxes are going up, all these different inputs. And I get very financially depressed, if that's a thing. And so when you look at the overall grand scheme of things, is that what you mean by structure and plan and building the platform you're building so that kind of thing doesn't keep you up at night like it does me?
Yeah, but like when we talk about it broadly macro, almost every big, like horrible recession comes from some unintended consequence of something that was supposed to be good, right?
Like an action.
Right. So one of the things that's always concerned me, and maybe it's not this recession, but to your point, the next recession, is this desire to try to avoid a recession.
Right.
Like it's somehow unhealthy. Like people have to think of the economic cycle as like a living, breathing cycle, right? And anytime you try to avoid an aspect of it because it's painful, it becomes more painful later on down the road. It's like you're, have some sort of ailment, right? And you're like, it's no big deal. And you take Advil, right, to like cover up the pain or whatever. And then like 2 years from now, you find out that the pain was actually indicative of something really bad, and you've just been taking Advil to cover it up. Maybe that's not the best analogy, but it's the best one I can think of if you think about the economic cycle as like living and breathing. Recessions are a corrective mechanism. And when you don't have that corrective mechanism, or you try to avoid the corrective mechanism, you result with bad things in the system that increase speculation and make people feel comfortable taking a lot of risk when they shouldn't be. And so, we're trying to avoid something that's a corrective mechanism, and it would be better if we just had a nice, shallow corrective recession and we went on our merry way. But no, we have to try to not have a recession at all, because that's bad for re-election.
And that's what I was just going to ask you. It's a function of politics, right?
Right. And so, people don't like recessions for good reason. Nobody likes it. It's painful. But like anything, you do it because it's a corrective mechanism. It keeps everything healthy and from getting too far one way or the other. And now I think you're right. I think you set yourself up for some unintended consequence of whatever policies were put in place to avoid the bad thing, for a while. And I think we have an entire generation of people, and I myself am included in here. If you think about it, I was talking to a Wall Street Journal reporter yesterday, and he was like, why do you think everybody thinks there's going to be rate cuts in a year? Because it doesn't seem to make sense to me, right? And I was saying, my thought here is, when was the last time we saw interest rates at 6%? Think about it.
07?
No. Oh my God. No. I don't think we've seen interest rates up over 6% since like 1999.
Wow, you're right about that. It's been some 30.
So it's been 25 years, really, since anybody remembers having, and that was low, because remember, we were coming off the 70s and 80s where we had double-digit interest rates. So we were in a declining rate environment, but it's really been since the late 90s that we've seen interest rates steady at 6-7%. I remember my dad getting excited to refinance his mortgage at like 6 or 5 3/4 back in 2000. So, it goes back a long way. And so we have 25 years of people in this business, people who started in the business in 2000, who are now in their 40s and 50s. Think about it, who have no idea that is actually more normal than the environment we've been in. Zero interest rates is highly abnormal, but we have an entire generation of investors that's all they know. So, I think people are inclined to think that like it won't happen. Despite any PTSD from the financial crisis, people don't look at that and think about it in the same way that they think about the environment that we're in today. That was the housing market. And we have some slides here that show that there's no potential bubble in the housing market. You cannot have a bubble when there's no supply.
Right.
You just can't. There's literally no supply in the housing market. Even for like the small amount of demand that exists with mortgage rates at 7%, there's no supply. And so when you think about that, the things that would cause a major problem are just, that's not it. It's the two more. This is rent prices. This is a CPI thing. Next one. That's it. We have month supply at 3 months across the United States on average, which is insane. Even during the housing crisis and going into the housing crisis, we weren't near these levels. Home sales are near record lows. Overall, availability of housing is just not there. Supply, sales, and the index as a whole that kind of gives you the idea of what's going on in the market are all at record lows. And so, it's hard to imagine structurally there's nothing in the system, but what's being done to avoid a recession are the kind of things that 10 years from now you see the consequences of. Which, so if you think about the financial crisis, that's kind of how that happened.
So what's like the societal result of a chart like this? I mean, you would think the logical progression is that rents continue to go up and up and up, and people just can't even afford to rent anymore. But that certainly isn't going to spur supply, right? What needs to spur supply is either A, that the price of homes go down dramatically, right? And that's could be helped by a recession. Or what? Home builders start to quintuple the amount that they build. I mean, they're not going to be able to keep up, right?
No. And the other, so really the only way housing can become affordable again is if prices drop a little and rates drop a little, because affordability is affected by rates, right? Because your mortgage payment, what you can afford changes drastically depending on what your monthly payment's going to be, which is impacted by your interest rate. For a while, home builders were able to buy down rates, but now it's getting to the levels where like that kills their margins completely. And so there's no real incentive. But to your point, rents go up, and rents is the input in CPI. Keep that in mind. And as long as labor supply is tight, if we go back one slide, I think, or two slides, here we go. Labor market is tight, rents can still rise. If you see this, you see when there's a rapid increase in permanent job loss, that's when you see rents crater, and we haven't seen that. So, you know, rent is a major input into CPI. Now, we can argue if the rent calculation in CPI is accurate because they use owner's equivalent, which is crazy.
Right.
But you know, it's worth considering how much can inflation come down if one of the major inputs has no technical reason to correct. And again, housing supply, that's a problem. I mean, that is actually an area where government incentive would make sense right now. But they're incentivizing things that make no sense, like EVs.
And they're terrible at it.
Yeah.
I mean, when they do incentivize, they're just bad at it.
I mean, they incentivized buying houses back in the 90s, right? Because that's when they made it easier to get home loans, and mortgage rates started going down. And that's what got us into this scenario to begin with. And nobody wants to sell their house now because you sell your rate. And nobody wants to do that. And so you have people who would normally downsize who aren't downsizing, because why would they?
I should have been able to guess what year that was, because I bought my second home in 2001. Actually, our closing date was September 11th, and obviously it got pushed because all the banks closed.
Yeah.
But I remember being excited about 6 3/8 on the loan there. So that's going to be my marker from now on. And I actually I think I offended a Bloomberg reporter in a TV interview because she asked me, you know, what I thought was something that people weren't talking about, which was a weird question because I wasn't prepared for the question. So I said, well, one of the things that struck me is that about 38% of C-suite people in the S&P 500 were not alive the last time rates were at 4%.
Right.
I'm sorry, not alive. They weren't working the last time rates were at 4%, let alone at 5 or 6%. And I said, I don't know if they understand what that means for their financial situation, for their funding.
See, you and me, totally on the same page.
Yeah. And she actually said to me, she goes, well, they can read, Bob. And I said, yeah, but Mike Tyson said, you know, everybody's got a plan till they get punched in the face. So it's a little bit different when you're actually working under this particular rate regime than you're reading about it. I mean, things come at you quickly, and it's a lot different. So
yeah, we were in a zero interest rate, zero inflation rate environment for decades.
Yeah. So with that in mind, the thing I keep bringing up, and you took it one step further, but I'm looking to my left here at the CME Fed Watch tool, which used to have a rate cut starting in March. Now they've pushed it out to the first rate cut being June. So they're getting better. They're pushing it out and pushing it out. What do you think, and I don't need a number on it, but do you think the probability of one more rate hike is more likely than a rate cut next year?
Yes.
Yeah, so one more hike. Do you base it off of, because what I base it off of is you're not going to get 2% inflation anytime soon. Not with the kind of numbers we're seeing with services PMI and UPS drivers making $170,000 a year now and all these different things. You're going to have a dramatic slowdown, not just signs of slowing, in order to get inflation down, number one. Number two, why would they at 3.8% unemployment?
Right.
I mean, unless they Jimmy's point is always that because they're idiots, because they're more concerned about the stock market than anything else. Stocks are doing great. So like literally all three things in my mind have to crater, with an unemployment rate shooting up at least past 4.5% for them to cut rates. You see any scenario where that can happen by next year?
So I completely agree with you, and I completely disagree with Jimmy, but we know this because when I was on with you guys back in June, we had a debate. I know he was, but you know what? Oh, well. But so I'd like to think that the Fed and, Chairman Powell will continue to keep rates higher for longer. They've continued to say that that's their plan. And I have no reason to believe that that's not true. I actually would be super concerned if they decided to cut rates without having any justification to do it, because that gets into the unintended consequences thing, which, I might be retired and, sold my company and living a good life at that point, but my son will have to deal with it. And, I don't want that for him. I started my career with the tech bubble bursting, and then, 10 years later, financial crisis. So, I've seen my fair share of problems in the financial markets during my career, and it's not fun. But I will say that I don't see a scenario of them cutting at all. Maybe pausing, maybe not raising anymore. But again, we've had GDP being revised upwards, right? We've had GDP numbers that we haven't seen even as we came out of the financial crisis. We had like 2 and 3% GDP for years, right? Slow and steady growth. We've been having numbers that are like substantially higher than that and revising upwards. How can you possibly put in a scenario where all of a sudden we see a massive decline in GDP, unemployment up? I'm going with the 5% number. That's where I kind of think. But you're right, 4.5 is probably the number. And inflation, kind of sticky around 3 to 4%. I just don't see a scenario where we all of a sudden drop off a cliff. And if we do, that's the only scenario I could see rate cuts happening, and you'd have to predict that that's going to happen. And I'm not convinced it will. But that gets into the unintended consequences of policy. But there's no indication right now that we have some boogeyman out there that's going to show up and markets are going to fall off a cliff. That's the only scenario I could see a rate cut in 2024 at all. I just don't think that, we went through an entire generation where all the Fed did was cut rates. 20 years of nothing but rate cuts. I think the last time we saw persistent rate hikes and consistently high rates was like mid-90s-ish. We had a spell here or there where the Fed raised rates for like a quarter or like a month during like the taper tantrum, if you recall, these kind of things. But there was never a consistent like year-long, every single meeting raising rates scenario. And so I just don't foresee any scenario other than like a massive financial disruption that would support the Fed cutting rates. I just don't. And, Nvidia blowing their earnings out of the water 2 weeks ago or a week and a half ago isn't supportive of, that scenario at all.
That was interesting because I thought Jackson Hole, Jerome Powell, Chair Powell had an opportunity to say we might accept a little bit higher inflation, and he didn't say it. So people just seem to ignore these things. I will say something for Chair Powell, and this is another thing that Jimmy and I kind of got into in our typical friendly debates. We all kind of dislike the job of the Fed over the last, let's call it 30 years. But I think knocking the Fed in this particular situation has gotten boring. It's gotten really boring. You see people on social media and then in the fin chat world, I'll call it, always saying the Fed did this and the Fed did that. Okay, fine. Now, if Jerome Powell is actually going to say, we have a mandate and we're sticking to it, which is what they should have been doing, by congressional order all this time. Why bash them about that? I mean, I think that's what I keep missing.
I actually would say that we saw Greenspan, we saw Bernanke, all of these former Fed chairs that very much were trying to do things to make the market happy and the politicians happy. And for once in the last year, maybe, and only because it bit them in the ass, doing it the other way. Have you actually seen the Fed do things that are actually based on what their actual mandate is? And only because them not doing that led to this insane inflation.
Yeah.
And I'm actually, in the last 6 months, I would say I'm actually kind of happy that the Fed is actually doing what's mandated and not trying to be popular. The question is, how long does this continue, especially when you have an election coming up?
Right. So
and job security comes into play here. You know, if there's a new president, they might decide that they don't like Chairman Powell actually doing the right thing, and they boot him out for somebody who's going to do something more supportive of politics and the markets, because that's really better for re-election.
That would be really interesting to see if someone else is in office and they work on whatever angle they can to fire him. That would be a really interesting development for us. So you have your own models, right? And so within those models, correct me if I'm wrong, there's some sort of medium to long-term active components. Is that right?
Yes.
Okay. So since you do have an active-ish background, what do you like? What's overdone? You could talk sectors, you can talk ETFs, you can talk specific names, whatever you like. What do you like? What's overdone? What do you hate?
All right. So I'll kind of start broad macro. I am thinking about what is going to do well if you pull liquidity out of the system. And that's going to be things like energy, materials, industrials. Energy since July has been the best performing sector in the S&P, and it's not even close. It's ahead of every other sector by, I think, 900 basis points, according to Tradier. And my friends over there, who I love, and all the charts that I sent over are from Tradier. I want to make sure they get their shout out. But Chris Rohn is brilliant, and of course this is going to happen. What did I tell you? What did I tell you? My TV is going to be delivered at exactly the wrong moment.
Go do it while I explain.
All right. You talk. I'll be right back.
I'm going to talk. So Shana talked about having ordered a TV. She just moved into a new office, which you see in the background when she's here. And she literally said, she showed us before the show when the delivery window was. And she said there's 100% chance that they're going to deliver this during the show. So in the meantime, I had one chart from Invictus that I didn't talk about. So I could talk about this since Shana and I kind of got off the subject of the labor markets. The sectors that are losing jobs, or the areas that are losing jobs in the markets, you're looking at sort of canary in a coal mine stuff. Again, this is from Invictus Research. Okay, it's again Mike Singleton. I guarantee you we will have Mike on the show, and he'll have more charts than you guys could even watch. You can find him at invictus-research.com, or just hit him up on Twitter, which is also Invictus-research, and tell him you saw how good his charts were on this particular show, and ask him if he wants to be on it. I can just call him and ask him, but I like when you guys do it. So this is cumulative payrolls month over month for manufacturing, home builders, temp agencies, and trucking services. Look at the last 7 months. Now, what Mike does here is he just takes the numbers and he assumes that when it goes negative, which is a fair assumption, what you have is net layoffs, right? Net job losses. And 7 consecutive months in manufacturing, home builders, temp agencies, and trucking services have all been negative. 7 consecutive months. So when people start talking about how sort of well the industries are holding up and the job figures are holding up, and then you point to Chair Powell and the rest of the Fed speakers all saying we need to see some slack in the jobs market, some weakness in the jobs market, this is a canary in the coal mine for that. But then you go back to what Shana said earlier in the show, is that she doesn't necessarily expect services to follow this down anytime soon, which is why we now have this narrative and what developed today. Today, we had yields rise in the front end of the curve. Now, I mentioned the CME Fed Watch Tool. I'm going to actually pull it up on the screen one of these days, not today. The CME Fed Watch Tool, if you've never looked at it, just go to CME Fed, just actually type into whatever search engine you want, CME Fed Watch Tool, and go down 2 tabs to the Compare tab, okay? That Compare tab will show you where the next meeting's probabilities of a rate hike has gone, where the market's priced it in, or a rate cut if we're in a cutting cycle. Then you go 1 tab down from that, and it's the probabilities. And it shows you what the futures markets are pricing in, or going all the way down, basically over the forward 24 months. And as recently as 2 months ago, they had rate cuts in 2023 on this particular tool. And then they took them out to December. Then they took them out to January, then to May. And now we've got them all the way out to the first rate cut happening in, I believe, the June meeting of next year. As Shana and I talked about, neither one of us believe that. I think Jim's point, and we could bring Shana back in now. Jim's point is that the Fed is going to crack under political pressure and under possible pressure if equity markets sell off, which hasn't happened yet. And I don't know if the political pressure is going to show up. I just don't think it's going to. So
I'm back.
I really wanted that guy to put the TV up behind you while we were doing it.
I know. Just for context for the audience, I joked before I came in, I ordered a TV from a local company, ABT, here in the Chicagoland area, and they will deliver it directly to your house same day and like put it wherever you want it. And I got an email from them saying that they would deliver it between 2:40 and 5:40. And I said, the odds are that they show up at 2:40 because that's just how these things work. And not only did they show up they showed up 4 minutes before 2:40. Of course they did. And
I would have literally prepared like a GIF or something to put in that box while you were gone had I known this early enough.
What are the odds that not only do they come on the beginning half of your window, but they come even before the window starts? Of course.
All right, so let's go back to the question then, because you were talking about how energy was a good performer, but did you actually say you liked it?
I do. Energy, materials, industrials are all areas that will benefit. Hold on, my cat's eating my cord. I'm just full of the blooper reel today. I think those are areas that benefit from less liquidity in the system. And so those are areas I like. One of the stocks that I just started taking a look at, and I'm not recommending it because I haven't done the work on it yet, but it's on my radar screen, is Diamond Head Energy. NOV I've owned for a little bit. Those are names I've kind of liked. I've liked Caterpillar. I own some Deere. But truth be told, I've been a fan of Nvidia my entire career. Nvidia went into the S&P 500 right around like my 2 or 3 year anniversary in the business. I want to say it was like 01 or 02. And I've followed that stock my entire career. I own it. I'm not selling it. I think it's a good company. I think it has major tailwinds. I don't think that is indicative that tech is, the way to go. I just think that that's a special case and I still own it. So that's a name I like, but on an individual basis. And when I'm looking broadly at sectors, energy, materials, industrials, those are the 3 areas I really focus on. And it actually plays, especially materials and energy, really play into my alternative investment area, because that's where you can actually get the direct exposure. We had on a podcast that my firm does, a woman by the name of Kellyanne Wingett, who runs a firm that does a lot of energy partnerships. It's in Texas. That's what you would expect. And that's where you can get great exposure. Materials, one of our clients is Diamond Standard, which is commodities, diamonds in particular, that kind of falls into that bracket. These are all areas I think are really beneficial. You can find them in, traditional ETFs, but you can also find a lot of really great direct exposure in the alternative space. MLPs are always interesting from that perspective, positives and negatives right now, but they have good yield and they can play into that space. So there's lots of opportunities, I think, in that space. The places I'm not bullish on, I really am not a big fan of discretionary right now. I think there's pressure on the consumer, and we're seeing weakness in the job markets, which is negative for the consumer. Rising oil prices, rising food prices, and rising rent prices are negative for the consumer. So all of those things are worth considering. And so for me, I'm just focused on some of the more cyclical areas where you're seeing some strength technically.
So it's interesting you mentioned Diamond Standard. Amelia Bordeaux's a friend of mine, and I don't know if you know her personally or not.
I do. I know her. She's great.
I'm starting to think of a show with like you, Cameron, Amelia, maybe a Brian Westbury, and Jim and I just don't do the show. It's kind of what I'm thinking.
That would be fun.
Yeah, for you guys, it'd be great. I'd watch it. No, we didn't know she moved from Exante to Diamond Standard, so we had her on to talk on our Futures Edge podcast about Diamond Standard. I thought that was just genius.
It is.
I thought that was a really genius. I don't like the actual diamond block. I think it's visually unappealing, but I guess that's not really why you're doing it, right?
Right. I mean, you're doing it, you have to standardize the diamonds, and that's how they do it. But, you know, to the broader point that we're trying to make here, that's a commodity and it's an alternative. And it's one of the areas I think are particularly favorable in the environment we're in now, where when there's less liquidity in the system, there's higher inflation. You have things that are now all of a sudden worth more because of those factors. And those things tend to be commodities. And the way that you can play it is directly in that alt space, like with a Diamond Standard or something of that nature, or indirectly by buying the companies that are exposed to it and using the ETFs markets or directly in individual stocks like, you know, Hess or Diamond Head Energy or NOV or any of those.
I actually forgot to use your title, Queen of Alternatives, and I'm very upset about that.
That's okay.
No, it's not. It is absolutely not okay, because you are the Queen of Alternatives. That is not a fake thing. So back to the idea of sectors. A lot of analysts, and I think this is one of those things personally, if you give me a second, I think sometimes people just say things because they know it'll go away if they're wrong, and they know they'll be the first one to say it if they're right. I'm hearing about an AI bubble now. Now, if AI is actually a 20, 30-year story, how could it be a bubble now? Is it a bubble?
I actually don't think it's a bubble. I think it's a long-term trend. But I do think that the bubble is in kind of, if you think about crypto, like blockchain and that technology is a long-term trend.
Right.
But you got to pick the winners. And when there's a lot in the space, they're not all going to be winners. It's a lot harder to pick the winners. And I think AI is kind of the same thing. Technology, you saw a tech bubble, right? But it was in the stocks, not in the actual trend.
Right.
I think that's what you're seeing in AI. Not that AI is a bubble, but AI stocks are a bubble because they're not all going to win. Now, Nvidia, to me, is clearly head and shoulders above everybody else. They have been for a long time. Nobody can compete with their technology at all. And they have been ahead of the curve for a long time. I remember in 2018, sitting in a room with a bunch of value managers, a bunch of value investors. I was working for a firm that only did value at the time. And at the beginning of every year, all of the people on the domestic equity team, of which I sat on, and I was on the domestic equity investment committee, would pick the one stock they expected to outperform for the year, right? Or the next 3 years. And of course, I'm with a bunch of value guys, and they're all like, picking their value names. And I was like, Nvidia. And they're like, that's not a value name. I'm like, I think it is, because I think the PE is wrong. Because in order for the PE to be as what it is, you have to believe that the earnings estimates are correct. And I don't think they are. And at that time, they were already really involved in the autonomous vehicle. Like, they were the only major chip maker involved in autonomous vehicles, the only major chip maker involved in anything related to AI. And they're so far ahead of the game. But I do think that there's a lot of other players that are just benefiting from this craze and kind of, on the coattails of Nvidia, but not real. And just like we saw in crypto, blockchain is real, crypto was a bubble. I think, 99 tech and all of what was happening in technology was real. And there were winners that came out of that. I mean, Microsoft did nothing for like 10 years. Now it's great. Apple, same thing. There were winners, but there were like 5 winners of the tech craze, right? 5 names, and you got to figure out what 5 they are. I think that's kind of where we are with AI.
So this is a strange question, because I'm not even sure it can be answered. When you look at, for example, an Amazon, right? Tech bubble, huge crash. Amazon came down quite a bit and then started its trek of never-ending growth relative to stock price, of course. Something like Nvidia, which, I feel like you're saying is an Amazon, right?
I think it's more like an Apple.
Okay, like an Apple, fair enough. Apple did the same thing, right? At some point, they came off from their highs. Does Nvidia? Of course, it's possible that could happen with Nvidia. But what has to happen for that to happen, where Nvidia kind of comes down to earth relative to the rest of the sector, and then kind of starts this never-ending climb where 30 years from now, you're like, I told you so?
A competitor.
And And there
they
is
don't have one.
Yeah.
But if you think about like whether it be Microsoft or not so much Amazon, and I don't consider Amazon tech.
Yeah, I don't either. I don't either.
I mean, it's a .com, but it is not technology. I mean, now they have the cloud services and things of that nature. But when you think about tech bubble, they were really just online retail.
Yeah.
But when you think about actual technology, like Microsoft, Apple, they took a hit when there were competitors in the space, right? They did fine because there were no competitors. Then competitors came into the space. They started losing market share. They had to become differentiated. Apple, I think, is a great example of a company that had no differentiation and then became differentiated by creating the ecosystem before anybody else did. And nobody has been able to replicate what Apple has created with their ecosystem.
Right.
Microsoft hasn't. Samsung hasn't. There is no other company that's created that ecosystem, which is why the Apple stock has just gone up and up and been actually quite stable. I think with Nvidia, it's going to have to be like a really strong competitor that takes share away. And right now there really isn't any. But that would be a scenario. Now, reminder though, Nvidia is down somewhat from its highs.
Yeah,
I mean, it was, I do recall no less than 2 years ago, the stock was, $400+ It's not like it split or anything. It went down, into the 200s and now it's bounced back, obviously, but it has taken some hit at some point. But I do think the only way you see a major drop off in Nvidia is if a major competitor came into the space and started taking share. But right now there isn't any.
I'm actually going to put up an Nvidia chart because I think it's an interesting thing to look at as we slowly start to run out of time. And I'm going to babble because I don't have it ready. But I'm going to put it up here, and you guys aren't going to be.
I just remember I'm gonna tell my own Nvidia story while you're doing that. I started following the stock when I got into the business because it was newer, and I noticed it was in the chips. And at that time, it was like $40. And one of the things that I made a lot of money doing early on was that it would always like go up to like 45, 50, and then it would sell back down, and you could like play that trend for a really long time until it got put into the S&P. Then all bets were off. But there was a point in time where like it would hit a ceiling. And it would just never go through that ceiling. And you could make money just playing the $45 down to 20. And that's how I started following the stock. And I followed it ever since. And then, when the AI, EV, autonomous vehicles, all that kind of stuff kind of came to be, and Nvidia became more important and the leading player in that space, I started looking at the stock again. But I've always followed. This is one stock I've followed my entire career.
I mean, that's awesome. I mean, I try to think of a more intelligent word than that, but to be able to be like sort of involved in watching the stock and having liked it that long, it's amazing. It's prescient. So it's interesting because I've been looking at Nvidia this year, and actually I bought some in here. And it's one of those things where somebody told me, it's so parabolic. How can you buy it? And I sort of took a similar approach. I don't have the background to look at the fundamentals and say that this particular valuation still makes sense. What I do have the background of doing is looking at the price action and saying it's going to continue to go higher for quite some time. So from a perspective of this, for me, I always look for things like you would see, for example, here, and this is a weekly chart, where you see pullbacks to an area and then a break back out up to new highs. Those are always sort of a recapture of a momentum for me where I can get in and I can continue to add. I have this line down here. I don't remember what audience I was telling this to, where I was able to, size my position correctly so I could place sort of a soft stop below $318 and just continue to add to it as it dipped from here. And I hope I remember.
But you can see what I'm talking about. It did dip quite a bit at one point last year. Yeah. And I know I purchased some there. And that's done well for me. And I can't bring myself to sell it because I can't think of a scenario where the stock tanks like that. And if it did, I'd want to buy more of it. But the thing that sticks with me is when I used to work at Fidelity, Will Danoff, obviously a legend, runs the Contra Fund, somehow manages to run like a massive fund and still do okay, which is like an anomaly of all anomalies. But I remember Will talking about Google when it IPO'd. Alphabet now, but it was Google back then. He was one of the only institutional guys that actually bought the stock at the IPO. And I remember him saying, and this always stuck with me, and it's been kind of a mantra, which is that PE is only as good as the E, and the E is an estimate.
All right.
So when you're talking about what somebody's trading at a forward PE of blah, 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 what you're saying is you think the estimate is accurate. And if that's the case, then you're right, it's expensive. But if you, the investor, think that the E is completely wrong, then it's actually a lot cheaper than people think. And if you think of what Nvidia just did in terms of earnings, and then you go backwards and calculate what its PE would have been if you had known it was going to kill its earnings the way it did, it was so cheap. And that's what you're going to think about.
I'm going to close out with this particular question about Nvidia. To the general public, right? This year started the AI story. Right, to the general public. Number one, did it start earlier to the institutions and the financial advisors that work with you? And number two, was Nvidia just that good already, and AI is just a story that they were able to capture?
Well, here's the thing. I just was commenting about back in 2018 when I picked it as my stock of the year. I had gone to a private equity conference where a lot of private equity guys were talking about EV and autonomous vehicles in particular, not really AI, but talking about how Nvidia had, a dominant position and everything related to that space. And that's what the PE guys were saying, who were investing in non-public companies, and they all kept commenting on Nvidia. And that was in 2018. I think financial advisors, broadly speaking, the mass affluent financial advisors, even the family offices, I don't know if they keep up with market trends in the same way the institutional guys do. And I don't know if the public markets institutional guys keep up with trends the way the venture and PE world does. And so I think you can learn a lot, and the smartest people tend to pay attention to those markets. I was at a conference right in 2019, and I remember seeing this one chart, and it stuck with me. You can tell if there's a new trend coming by the number of new patent applications that are coming out. And in 2019, there was a record number of patents that were issued, all related to kind of this AI EV stuff. But you wouldn't have noticed it unless you were in the venture capital world or in that space. The average person, the average advisor, even the average public equity institutional person was not paying attention, because you have to really think about it that way. And we've seen record numbers of patents being issued related to this space now for 4 or 5 years. So it's not new. If you were paying attention to some of that stuff, it would have, piqued your interest. But I'm going to make a great full circle here. The reason I am so obsessed with alternative investments is because I learned that the things that fall into that bucket are the canaries in the coal mine. Remember, I'm telling you that Nvidia got on my radar screen because private equity and venture capital guys were talking about it. And when I first was introduced to the alt space was right before the financial crisis. And everybody in the alt space that was doing any sort of credit was seeing liquidity problems. And then you had the August, value stocks sold off because margin calls and the less liquid stuff. I've just found that paying attention, whether or not you invest in the space or not, that's a personal decision. But if you really want to know what's going to happen 5-10 years from now, this is the space you want to pay attention to, because all of what is coming can be seen by paying attention to venture capital, private credit, what's happening in, private equity. These types of things are the canaries in the coal mine of either positive or negative things coming in the future.
This is why you watch this show. That last whole, delete the rest of the show. That last whole part was unbelievable. I remember a friend telling me, I have a friend that builds the refrigeration companies for Pfizer. It's going to be huge. That's not what you look at. You look at patents and what the private equity guys are looking at. That is, I'm speechless, which has never happened in my entire life. So thank you so much. I owe you one. More importantly, Jimmy owes you one. And tell everyone where they can find you if they want to find you, whether it's just to watch your stuff and check out your podcast, etc., or just to actually get in touch with you.
Well, first I'm going to say, Jimmy, I expect dinner I don't live that far from your restaurant, and I'm going to stop by, so you owe me. You can find me on Twitter.
Barely get him to give me a drink when I was there. Go ahead.
You can find me on Twitter, Shana S621. I wish it was a better handle, but it is what it is. I've had it for 10 years. I can't change it now. You can find me on Instagram, finance_queen2020, LinkedIn, banyancapital.com. We have a YouTube channel. If you look up Banyan Capital, you can find our YouTube channel. Subscribe, follow. You can get our podcasts. You can find me pretty much everywhere, but there are some direct ways to get in touch with me.
Shana, thank you so much. This has been awesome.
Thank you.
We will see you guys next week.